Assalamualaikum and hi everyone. I am Nur Nabila Binti Rahman, metric number 281564. Now I will start the presentation. In Islam, economic activities such as trading is regarded as the essence of deen or religion. This is obvious from the Prophet Muhammad SAW statement that a person who delivers commodity from market to market will gain spiritual sustenance. Throughout Islamic history, the Prophet Muhammad SAW has engaged in the commodity trading with traders from different countries. Besides, there are also numerous verses in the Quran that encourage Muslims to engage in the trade with people from other countries. Therefore, trade finance can be defined as a specific area of a finance that examines underlying international trade transactions. As the function of trade finance is to introduce a third party to transaction to remove the payment risk and the supply risk, trade finance provides the exporter with receivable or payment according to the agreement, while the importer might be extended credit to fulfill the trade order. Thus, in Islamic trade finance, it consists of providing Sharia-compliant export and import financial tools. These are financial solutions and guarantees which facilitate transaction between buyers and sellers of goods and services. Meanwhile, conventional trade finance revolves around products such as credit or payment guarantees. Direct cash payment finance only a small portion of international trade. The largest share of trade transactions are conventionally financed either by open credit arrangement or by bank intermediary. Therefore, in this study, it is aimed to identify the differences between Islamic trade financing instrument and conventional trade financing instrument. Besides, it is also to study about product of Islamic and conventional trade financing. Lastly, to define the issue and solution about Islamic trade financing instrument that commonly happen nowadays.
Assalamualaikum warahmatullahi wabarakatuh. My name is Putri Nuraini Iwani binti Megat Raimi. My metric number 279984. Difference between Islamic trade financing and conventional trade financing. Before that, what is trade? Trade or investment is a capital investment activity that aims to finance a project. Investor will share the profit and will defer losses. For the conventional trade, conventional investment is through a method that is not allowed by Islamic law, namely loans that have element of riba in it. Meanwhile, Islamic investment is in according with Sharia guideline, so that every instrument and arrangement in the investment complies with the requirement of Sharia and Islamic law. Conventional capital market investment established in Malaysia in 1937, and Islamic capital market investment in Malaysia was established in 1997. For conventional trade, financial service based on riba, which is interest, gambling, production or sale of goods that are not halal, sale and purchase of security, which is investment that are not approved in Sharia. But in Islamic trade, the Islamic market is free from activities prohibited by Islam, as well as free from elements such as riba, gharar and maisir. Conventional investment is subject to company and national regulation, which is interest bearing and no profit loss sharing. Meanwhile, in Islamic trade, investment are based on profit and loss sharing, not like conventional trade. Conventional investment that promise a fixed return at the beginning of the contract, for which this investment do not involve an actual partnership between the parties involved. The fixed return promised at the beginning of an investment contract is riba, and it is haram in Islam. Meanwhile, in Islamic trade, for example, in the mudarabah investment contract, the customer as the investor and the bank as the entrepreneur. There, they share the profit when making the profit, while the loss will be borne by the investor. This coincides with the method of fee, which means every return is with risk. This actual profit and risk sharing is fair and does not burden any party involved.
Letters of credit play a crucial role in international trade and have been described as the lifeblood of international commerce. Islamic markets offer different instruments to satisfy providers and users of funds in a variety of ways, which is sales, trade financing, and investment. Basic instruments include cost-plus financing, murabahah, profit sharing, mudarabah, leasing, ijarah, partnership, musyarakah, and forward sale by as-salam. These instruments serve as the basic building blocks for developing a wide array of more complex financial instruments, suggesting that there is great potential for financial innovation and expansion. The basic murabaha transaction is a cost plus profit purchase where the item the bank purchases is something the customer wants but does not have cash at the time to buy directly. In meaning, an Islamic bank buys a product normally at the request of a client who promises to buy it from the bank. The bank takes the risk while it owns the product. The bank then sells the product to the client normally on deferred payment basis. The contract is similar to a rent-to-own arrangement in that the intermediary retains ownership of the property until the loan is fully paid off. One of the most widely used instruments for short-term financing is based on the traditional notion of purchase finance and is presently used to finance working capital requirement, import and export financing. Besides that, murabaha is also being used for purchase of fixed assets such as lands, building, machinery and equipment, automobiles, computers, furniture, and also suitable for financing purchase of personal assets and consumer durables such as cars, house, and etc. A proper murabaha transaction differs from conventional loans in a number of other ways. After the murabaha contract is signed, the amount being financed cannot be increased in case of late payment or default, nor can a penalty be imposed unless the buyer has deliberately refused to make a payment. The seller also has to assume any liability from delivering defective goods. Sources differ as to whether charges for late payments are allowed, with some authors stating late fees sought to be donated to charity. Murabaha is not a loan given on interest, it is a sale of commodity for cash or deferred price. Proper murabaha involves guidelines such as the bank taking actual possession of the good before selling it to the customer to ensure that a murabaha transaction is based on trade between the bank and the customer and not merely a financing transaction. However, the finance provider does not bear the risk for the entire period of the contract. The risk exists only during a time when a spot sale is made and until the products are delivered to the customer. For the remaining period of the contract, the amount of financing plus the agreed markup is in the nature of debt and is risk-free, given that security is normally provided. Not only that, murabaha is that it is not always applicable. It cannot be utilized, for example, when the price of the good cannot be determined. That is all from me. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nasabina Alimatika Maruslan. My metric number 279934. I will be explaining about issues and solving Islamic trade financial instrument. The next discussion on Islamic trade financing is on Sharia issues that occur when the implementation of the products is carried out. These issues were analysed based on the views of the jurists of the forensics and contemporary jurists. Among the issues that occur are first, riba issues, and second is God issues. For the first issues is riba issues. In today's world, this trading activity takes place involving letters of credit. This letter of credit is in accordance with the provisions of the regulations contained in the Uniform Custom and Practice for Documentary Credit, which have been issued by the International Chamber of Commerce. Although UCP or Uniform Custom and Practice is not a legal matter, it is applied most letter of credit transaction. This is because usually the parties using this letter of credit will apply the UCP in the contract. So, the issues raised is whether UCP or Uniform Custom and Practice is in line with the implementation of the Islamic letter of credit. The emergence of Islamic banking does not produce a form of Islamic letter of credit which is different from the previous one. Therefore, the operation of this Islamic letter of credit has been regulated by the same UCP or Uniform Custom and Practice as conventional banking. Conventional banking still maintains the products of Western practitioners and experts.
The solution to the above issue is, before trying to certify a contract, that person must examine the contract before signing the contract. The contract that have been used in Islamic trade transaction are murabahah, wakalah, musyarakah, kafalah, bai, adain, mudarabah, tawarru, and also in BBA, which is bai bithaman ajil. Most trades within Islam use murabahah contract. Murabahah is a transaction with the seller stating the buyer of the price of the goods and selling it by mixing the amount of profit to the obtained, whether in whole form or in a certain form of unit.
For the second issues is the goods issues. The legal condition of the goods stated is that the item must be the item which is permissible by Shara. The item in question is permissible by Shara, which is an item of value to Shara and is valuable in the response of two parties who wants to buy the item. Therefore, trading on worthless goods is non-permissible. Items that are of no value in Shara are such carcasses, blood, pork, liquor, and so on. So, the issues is that arises regarding a wishful bar that uses the wakalah letter of credit is mainly the rules. The purpose is to ensure that an item is truly halal before the wakalah letter of credit is issued. In addition, there are also differences in practice between countries in determining the halal status of a product. There are also some banks that require a halal certificate from the exporting country to verify the halal status of a product. However, banks in Negara Malaysia have listed all types of goods that are not allowed to be traded under Islamic financing. For example, wine, racehorses, pork are either fresh or frozen.
The solution for above issue is, before we want to make a trade, we must make sure that the goods we want to trade are goods that are not prohibited in Islamic Sharia. Nowadays, this is often the case where the book says that there is a lot of trade in goods that are prohibited in Islam as well as wrong in Islam. For example, trading dangerous weapons with the aim of selling to enemies or rebels. In addition, the superiors must also be concerned about this issue. If the goods traded are goods that are not permitted by Islam, then action must be taken so that this does not happen again later. In conclusion, as an Islamic country, we must follow the Islamic trade financial instrument as the basis of any economic activities. This is because Islamic trade financing instruments are based on the Sharia compliance. And as a Muslim, we must follow the Sharia to get the blessing from Allah Subhanahu wa Ta'ala. Sharia is explicitly mentioned in the Surah Al-Jathiyah verse 18. Then we put you, Prophet Muhammad SAW, on the ordain when concerning the matter of religion. So follow it and do not follow the inclination of those who do not know. Therefore, it is important to use the Islamic trade financing instrument since it can play a sustainable role to support trade, foster growth, and accelerate post-pandemic recovery. In addition to its impact on the domestic country, it enhancing Islamic trade financing and can bring the benefits to other organizations of Islamic country and for the global Islamic finance industry in which Malaysia is an established leader. That's all for our group. Thank you.